Something just happened inside the United States financial system, and almost no one has noticed it yet. Over just 2 trading days, November 28th and 1st December, the Federal Reserve injected nearly $25 billion of emergency overnight liquidity into the banking system. First, an unexpected 11.3 billion spike, then immediately after the weekend, another 13.5 billion. And this came barely 30 days after the Fed injected 29 billion on October 31st, one of the largest repo operations in years. Back-to-back liquidity injections of this size are extremely rare, and historically when the Fed steps in like this outside of a crisis, it means one thing. Something in the plumbing of the financial system is under stress. This isn't noise, this is a signal. To understand the importance of this event, we need to understand one simple question. What is an overnight repo? A repo is basically a short-term repurchase agreement. A bank hands a Treasury bond to the Federal Reserve and gets cash for one night. The next day, the bank buys back the bond. A repo loan is like pawning your watch overnight because you're short on cash. The next morning, you buy back your watch. Banks do the same, but with billions in treasuries. Banks only do this when they need cash immediately and cannot borrow it from other banks. So when you see repo usage explode like this, it means liquidity is tight, banks are under stress, someone somewhere needed money now, and no one else wanted to lend them. This spike didn't happen in a vacuum. It happened the same week Treasury auctions struggled, bank reserves fell to multi-year lows, and money market liquidity hit tight levels. A 13.5 billion spike is not normal, it's a distress signal. Most people see the number, but not the scale. On a normal day, overnight repo usage is near zero. Even in volatile markets, spikes barely exceed 2 to 5 billion. But the last 30 days have been anything but normal. We first saw an unexpected 29 billion repo spike on 31st October, one of the largest since the pandemic crash. Then the pressure didn't fade, it accelerated. November 28th, 11.3 billion. December 1st, 13.5 billion. Nearly 25 billion of emergency liquidity in just 48 trading hours. This clustering is highly unusual. Nothing this persistent or tightly packed has occurred since the March 2020. We haven't seen repeated spikes of this scale since 2008, and even the dot-com era never showed up repo stress this compressed. The message is simple. These aren't isolated events, this is a pattern. A tightening spiral, a system signaling strain. Whenever repo spikes cluster like this, it means liquidity is deteriorating, banks are under funding pressure, and the Fed is quietly stepping in to stabilize the plumbing. The stress isn't easing, it's building. Historically, large repo spikes have always meant the same thing. Liquidity somewhere in the system is breaking. When banks don't trust each other, they stop lending to each other. When they stop lending, they go to the Fed instead. This is the plumbing of the financial system, and right now the plumbing is rattling. Let's look at all the major examples from the last 2 decades. The dot-com burst. Repo injections surged in late 2000. Markets seemed fine until suddenly they weren't. The Nasdaq collapsed 78% over the next 18 months. The Great Financial Crisis. Liquidity injections began months before Lehman failed. Banks were under stress long before the public knew. The repo market blew up in September in 2019. Fed intervened heavily. 5 months later, global markets froze during COVID. But the fragility had already been exposed. Pandemic liquidity freeze. Repo usage exploded to record highs. Within days, the entire US Treasury market stopped functioning normally. The Fed had to open unlimited liquidity windows. The regional bank failures of 2023, before Silicon Valley Bank collapsed, before First Republic failed, before Signature Bank disappeared, the repo market showed large sudden liquidity stress. So every time repo spikes this high, volatility rises, a bank or fund reveals trouble, Treasury markets start wobbling, the Fed is forced to intervene again, metals begin moving up. Repo spikes are early warnings, not aftershocks. This repo spike didn't happen during a normal market environment. It happened during one of the most fragile periods the US financial system has seen in years. Here's why it matters. The US government is burning cash at record speed. Washington is spending $22.5 billion per day. Someone has to buy all those new Treasury bonds, and the banks are drowning in them. Treasury auctions keep stumbling. Foreign buyers are backing away. US banks are being forced to take more and more of the supply. They don't have enough cash, only collateral. Banks are stuffed with bonds but short on dollars. They're sitting on piles of treasuries but not enough liquidity to operate comfortably. This is exactly the environment where repo markets break. The spike happened before the usual year-end stress. Banks usually need extra cash in late December, but this happened at the start of December. That means this wasn't seasonal, this wasn't routine, this was stress. So, what does a spike like this usually lead to? History gives us a clear path. Volatility starts rising, stocks get jumpy, credit spreads widen, volatility index or the VIX, the market's fear index, picks up. The treasury markets start acting strange. Yields swing more than usual. Auction demand weakens. Liquidity, the ability to buy or sell easily, dries up. The Fed steps in again. Once the Fed opens the liquidity door, it almost never closes it right away. It becomes firefighting. A bank or fund reveals losses. Every major repo spike has been followed by a fund blow up, a bank scare, or a liquidity failure somewhere in the system. We just don't know where yet. Precious metals react. Gold rises first, silver follows, usually with more force. And with over 100,000 open silver contracts in March, any liquidity stress can accelerate the short squeeze. This isn't about fear, it's about being prepared. Here's how sophisticated investors handle early warning signals. Hold more liquid assets. Cut down on unnecessary leverage. Avoid complicated positions that require perfect market conditions. Stay clear of investments that can freeze or lock up. Historically, real assets outperform during liquidity stress. Gold, silver, commodities. They hold value when the financial system wobbles. You don't need professional tools, just keep an eye on repo numbers, treasury auctions, VIX, money market flows, bank stress headlines. They will tell you when pressure is rising or easing. Short-term volatility is noise. Structural shifts like the ones we are entering create long-term opportunities, especially in assets that have been artificially suppressed for years, like silver. This isn't the crash, this is what happens before the crash. A $13.5 billion repo injection isn't a small detail. It's a message from the deepest part of the financial system. A message that pressure is building and the Fed has already started responding. History is clear. Repo spikes come first, the consequences come later. We're entering a phase where liquidity, leverage, and structural imbalances will decide the next big move in global markets. Stay informed, stay prepared, and stay ahead. This is MarketVelugu, Light on Markets.